Hey, welcome back, traders. It's John. It's November 10th. I'm recording this at approximately noontime on the 10th. Again, the presentation is made by Rain King LLC, and I'm an amateur individual growth stock investor. So our agenda today is to talk a little bit more, zoom out to the big picture. Then we'll get into the indices, the trend monitor, and then we're going to go over a watch list and some of the leading stocks to watch. And we're going to do it in two different parts, and then we'll wrap up. So let's look at the big picture, zooming back out. So this is a chart using the Dow of a secular supercycle bull markets. Now, I invite you to go look at the June 23rd general market update video. I take 5 or 6 minutes and I break down this supercycle concept so you can see it in more detail. But today I just wanted to refresh everybody's memory that currently we are in a bull market supercycle that began in 2009. And as a quick overview, these supercycles tend to last for 25, 26 years. So in that premise, this could go on till 2035. And it's really being led by the demographics. The millennials are the driving force. And in the June 23rd video, I explained that demographics in much more detail. So I encourage you to go look at that. Now, if we looked at a monthly chart of the NASDAQ, and I've shown this periodically every few months, again, looking at the super cycle, this long-term support trend lines that I've drawn on the monthly chart shows that even with the bear market of 2022, and I said this throughout the entire bear market, that if we came down to the 10,000, 11,000 area, we would still be in the context of the super cycle bull market. And as we all know, the current low in the market was around 10,088 made in October of 2022. And we've had this rally, and now we've pulled back a bit. So that's the big picture context, that we're still in a bull cycle. So now I thought it'd be good to look at some of the sector performance since the market bottomed in October of 22. So I've just pulled up the ETFs from the S&P series, and there's a lot of different things here that are interesting. You'll notice that the S&P is this black line showing its performance over the past, since the low on October 13th. You'll see that the sectors that have outperformed the S&P are XLK, technology, communications, as well as the home builders, even with this very long, drawn-out 3-month correction period that we've had. So let's break out the bottom here, a little more detail. Again, here is the upper half, which is showing the technology, communications, and builders have outperformed. And you can see the ones that are clustered right around the S&P line are showing that the industrials, the consumer discretionary, have basically been in line with the S&P's performance. And financials have underperformed, and that's still been a troubling spot for the market. We need financials to participate if we're going to get a bull rally. Now, I've broken out the bottom half, just showing you the underperforming sectors. And you can see right now that XLV is healthcare, XLP is the staples, and XLU is utilities. You can see that in this corrective period, they've all underperformed. But this is interesting that the defensive areas of the market are not moving higher in any meaningful way. And that's important because typically when you see a recession ahead, fund managers will go to consumer staples and healthcare, some of these defensive areas. So we'll have to see how it plays out. But it's interesting that the bull market sectors of technology and communications and stuff have outperformed the past 12 months. So let's get into the indices. Going to pull up the chart here. This is the S&P 500. We had this very sharp push in the S&P last week off the Fed's comments, Powell's comments, and we got a push to continue above the 50-day in red here. And we had our first distribution day yesterday, and it's approximately 6 days off the follow-through day. So it's okay. That's normal, not a big concern. We're usually very concerned if that first distribution day is in day 2, 3, 4, or 5. So we had mentioned that the breadth was really improving last week, which was in line with this strong push. But the question remained, is this just a short covering rally, or is this really bullish accumulation? So you can see we've had distribution yesterday, but what's interesting is when you look at the breadth of the New York Stock Exchange this week, It's not all rosy. On Monday, we had the S&P actually up 0.18, but the breadth was negative. So that's what we call a bad up day. And then you'll notice that on Tuesday and Wednesday, we had two more up days, and the breadth was really negative again. So we had two more bad up days, basically telling us that the breadth under the market indices, in this case, the S&P, is worse. So the index is masking some of the weakness. Yesterday, things were in line. Unfortunately, it was on the negative side. The S&P came off 0.8 and the breadth was very negative. So this is not what we want to see on this rally. So we're going to have to watch this very closely to see how it shapes up. Now, switching to the NASDAQ, I've shown here new highs minus and new lows. So I'm looking at the green are the plotted new highs and the red are the new lows. And you can see this avalanche of red that we've had. And you'll notice that I've plotted the two follow-through days. This follow-through day here eventually failed. And this is the follow-through day we had last week. And you can see we only had 2 days of net new highs on the NASDAQ, and one was minuscule before this thing completely rolled over. And you can see here the last 3 days, things have gone red, and a spike in new lows on the poor bond auction, which led to rising yields, which hurts stocks. So this is just not a good picture. We really need net new highs. Now, I wanted to again look at the bigger picture. Back in January, and you can refer to the January 27th general market update for this breakdown. But when you have something called the January trifecta, the S&P tends to be a good performer. It tends to give you a 17% gain on average during the year. So let's look at this closer. We also talked in the January video about the Whaley breadth thrust, and I explained that in the video. But the point was the expectations after you have a thrust were what we were looking for. We said forward gains after 3 months and 6 months were kind of signposts that we could look for. So I've gone back to the chart and said, how are we doing against these signposts? So here's the S&P in blue, and here's the initial January thrust on January 12th. And I've highlighted here the markers that we established with the Whaley breadth thrust. The 3-month marker was in April. We should have been about 1461, which is the 12% gain, but we were woefully below that in reality. In July, we made up some of the ground because we had that rally, but we still were below kind of this marker of where a typical data shows us we would have been. And then we've had this correction. So it's been a 12% correction roughly in the NASDAQ, a little less than the S&P. Now, the January trifecta target, I mentioned 17% was the average gain. But when you have the trifecta, plus you're coming off a down year like 2022, the average gain is almost 28%, which would have been a target on the S&P of 48.76. So just looking at the delta, you can see right here, we would need a 12.1% rally in the S&P to have any chance of hitting that target. Maybe we don't even get there. It's pretty tall order coming out of this correction. We'll have to see. We're in a seasonally good period, but it's just an interesting perspective of how this year is shaped up relative to some historical data off breadth thrusts. Again, these things are not predictive, but they're just good things to measure how we're doing. Now, last week on November the 3rd, last Friday, we had a Zweig breadth thrust, which was from Marty Zweig, who is no longer with us, but his great book, One Up on Wall Street, is worth a read. Essentially, he has another 10-day measure of breadth. And here's the data from Carson Research that shows that, what is the 1, 3, 6, and 12-month performance once you get a breadth thrust. And you can see that this table is generally green. I'll let you pause your video player and look at it in a little more detail, but it's saying that 6 months out, we could have a 13.2% gain. A year later, much higher. Even the results in median gains in the 1 and 3 month period tend to be positive. So that's a nice thing to have in the markets pocket. Now the trend monitor, we've been looking at this consistently. So we've had a follow-through day. It was a day 4 follow-through day, 1.64%. Now we've had our first day of distribution. That's fine, day 6. So far, so good. Bases and breakouts, how are they working? Some bases and breakouts are still happening. There are some bases setting up, and we're going to talk about them. But some of them haven't got very far. They've reversed. But there are some that are working, but it tends to be a little thin on the number of names. Now, the net new highs, we just hit this in detail. It's still the weakest indicator. We have not been able to get any trend of net new highs, and that's a significant concern. A bull rally will see net new highs on a consistent basis, and we're just not getting it. Still have consecutive days above the 20. We're still above the 20. And the positive breadth that we saw last week has reversed. We had really 3 bad up days this week where negative breadth below the surface is concerning. The volume so far has been higher on the rally surge. Now we have to watch the price and volume action on the pullback to see what it tells us, if this market has some support or it's under distribution. Now, I want to talk a little bit about the news and some tests for the market that are coming up. Now, in general, when you have bull markets, strong bull markets, they shake off the bad news. They just put it aside and the market keeps moving higher. Now, the past 2 years, as we all know, this has been a very news-driven market. Lots and lots of uncertainty is creating news-driven days where we're up, we're down. It's very difficult to get a trend. It's a tough environment. Now, one of the things that helps us from a sentiment perspective is, when a bear market stops going down, when there's lots of bad news, that's actually a bullish contrarian sign. So with that preface, we have some really good tests coming up about news, and we're going to watch closely how the market reacts. Now, we've had some bond market treasury auctions this week, and Thursday, as I mentioned, was really a weak auction. The buyers did not want to pay what was offered, and they held out until the price came down. So bond prices came down, yields went up, putting pressure on stocks, particularly growth stocks. So we want to see how those auctions are held. That's not a good sign that there really isn't an appetite for buying bonds and pushing bond prices up. Now, the Israel-Hamas war, lots of news going to come out. Will the conflict stay contained? Will it actually expand? So as headlines are coming out, we want to see, how does the market handle that? How does the market react? Government shutdown. In about a week, we have this deadline of another government shutdown that was postponed from the early October stage. It's back before Congress again. So let's see what those headlines do and how the market reacts. We also have the CPI report next week, give us another clue about inflation at the consumer level, and then the PCE report will be coming out the following week. So it's important to watch the news and the market's reaction, which is the most important thing. So watch lists. I'm going to break this down in 2 parts. I want to start with looking for new merchandise. It's really important that we keep our eyes open to new merchandise for bull markets. So what I've done here is I've taken the Renaissance IPO ETF, which is an ETF tracking IPOs. And you can see here, I've gone all the way back to the 2020 COVID low. And I've just plotted, a basket of IPOs that came out essentially in late 2020 and 2021, which really turned out to be, the peak of the market was in November of 2021. Not a good time to come public. Now, we've also seen in 2023, we've seen a little more activity with IPOs, and you can see I've plotted a few of the names that have come out. So what's interesting, though, is, this tracking ETF, if you look at 2023, you can see that this is actually up for the year. The IPO index here is up 31%. That's encouraging. Now, it has not been easy. There have been winning stocks from the IPOs that have come out in the last 2-3 years. Globe's up 80% in 2023. AppLovin, Duolingo, Shark Ninja, and others have had very, very positive years. And even stocks like DraftKings and Palantir, they're still relatively young companies. They came public only 2-3 years ago. So they're still really young in their life in the market. Now, recent IPOs have not fared as well. You can see the basket here of showing that Kava and Odd and even ARM, which was a really publicized IPO, they're all negative on the year. So it's not easy. It's still hard, but we want to keep our track of some of these names, because some of these names could become winners in the next up leg. So I've dug a little deeper and I've pulled out some of the names that I think look really interesting and they look like they have some potential going forward. Here's Aploven. These are all weekly candle charts. So this is Aploven, which is actually, I think I have the wrong chart here. I'm sorry about that. This is actually not Aploven. So let's skip that one for now. This is Shark Ninja. Nice move off the bottom as an IPO, and now it's formed a cup base. So this might be its first real base. So this could break out. This could be really an interesting situation. Duolingo, again, weekly chart, you can see that as the market was correcting, it formed this double bottom, and then it tried to break out, but the market held it back because we were still correcting, but it had a powerful earnings report and has really gapped up in a big, big way. So it's acting really well, young company with some potential. Here is Braze. Now, Braze is another young company, had a nice uptrend, and then we've got this double bottom that is formed. Very interesting double bottom. We're seeing a lot of double bottoms because of this multi-leg correction that we've been going through. So that's one to keep your eye on. Here's ARM. ARM came down and starting to form kind of an IPO U-turn. Maybe this will be its first base. Maybe it breaks out. Keep an eye on it. Core, this is off Coursera. This is another weekly chart. Now, this is interesting because it had a nice move off the lows with a lot of blue volume spikes. So there's definitely some accumulation going on. And during the corrective period of the market, you can see that this has formed a flat base. It's 15% deep, pretty tight closes. So this is an interesting piece of new merchandise. So let's look at some of the other better actors right now that are acting strong. Here's DraftKings, as I mentioned. It was kind of a double bottom-ish base. And I say that because the second leg did not undercut the first leg. So it's not really a double bottom if you're a purist, but it has double bottoms look to it. But the most important thing is it had such a powerful earnings reaction and follow through this week on good volume. Very, very strong stock in the market. Uber is more of a pure double bottom. You can see the second leg undercuts and shakes out, and then it's had two powerful up weeks pushing to new highs. So that's a stock that's really acting well. Deckers also had a big earnings gap about 2 weeks ago, and now we're seeing 2 more weeks of follow through. So that's acting really, really strong. Some other strong stocks. Here's CrowdStrike, and I spoke of CrowdStrike at the Blue Sky event. It was actually my power pick, and I went over all the reasons why I liked it. But you can see here that during a corrective period of the market where it's weighing down these stocks, CrowdStrike has really formed kind of what we call an ascending base. So it's had 3 pullbacks, smaller, and it's trying to push to new highs, 52-week new highs. So that's an interesting situation. Palantir. Palantir's formed a cup with handle. It pushed out last Friday, and it's starting to get some follow through today. And on the large cap side, the big cap side, Mr. Softy, Microsoft, has also been acting really well, came out of this double bottom, and is now pushing to, I believe this is an all-time high for Microsoft. So it's probably the best acting of all of the big 8. So there's a good dozen names that I think you should keep your eye on. Some of them are setting up pretty well. So let's wrap up. So the summary is we've got this follow-through day. It's still in play. We've had a day of distribution. That's okay. The real test is, can we consolidate last week's thrust up and then move higher? We're looking for that. We're trying to monitor that. Now, the trend change, very, very mixed action. What I don't like about what I saw this week is the IWM. The IWM has given up more than half of its gain from last week, which starts to suggest that maybe that was a bunch of short covering, and maybe it wasn't really bullish accumulation. So that's not the kind of action we wanted to see. We do know it's a strong period for the markets, and you should continue to build your watch list and also watch these leading stocks. Even if you don't own them, there may be ways to get into them at a proper buy point. Exposure levels I've kept the same. Given the action has been a little bit negative, the feedback we got this week was really generally weak. The IWM gave back much more than I would have liked to have seen. And we talked about the breadth underneath the S&P was weak with these bad up days. So that's not great. I think the exposure level stays the same. But we have to just watch. We have to watch and wait. We always learn more about the strength of the rally on the pullback. So let's keep our eyes watching things. If we get some support and we actually can turn up to push up higher, that would be an opportunity to maybe we can add some more exposure, but only if your positions are already in some gains. If you don't have gains, you really shouldn't be putting on more exposure. Now, if things go the other way and we see more deterioration and things start breaking down, you just got to take your losses quickly, swiftly, and get out and retreat. And so you have your capital in place, the remaining capital for the next follow-through day. So we need to be flexible. And the quote of the week is from Peter Lynch, and it's all about flexibility. He says, "As I look back now, it's obvious that studying history and philosophy was better preparation for the stock market than studying statistics. Those who are trained to rigidly quantify everything are at a huge disadvantage." I interpret this quote to be about flexibility, and we're at a point right now where we need to remain flexible. This rally may continue, and we might want to put on more exposure, but if things start to go the other way, we'll have to back away and cut any losses and protect ourselves. So I wanted to make that point. And I also want to thank everybody that attended the Blue Sky event last Saturday. We've gotten tremendous feedback. Thank all the speakers for a wonderful, wonderful day. And I thank all of you for joining us on that and really, really participating. Thanks again for Blue Sky. And next year, we are planning Blue Sky 7 to be in Boston in person. So that's the general market update. That's all the time I have for now. It's November 10th, 2023. Here's where you can find me on X, my YouTube channel, and you can also email me at rainkingbullbear@gmail.com. Have a great weekend, everybody.